What's up there? This is the ultimate guide to ICT GAPS, in which we'll go from basics of imbalance and inefficiencies, covering the BISI and SIBI, to fair value gaps and inversions and stuff. So without much saying, let's get into it. First of all, what are ICT GAPS? The market is always reaching for some liquidity, be it sell side or buy side. While printing price to a drawn liquidity, algorithm often create these inefficient or imbalanced price action. You might think of it as a mistake, but it's a very reasonable choice to trap the retail traders and offer enough opportunities. These gaps can be created due to inefficiency in price delivery, high volatility, or to offer opportunities to smart money or us as institutional traders. The ICT gaps that we'll discuss in today's lecture are imbalance, SIBI and BISI, fair value gap, and inversions. Let's start off with imbalance and inefficiencies. When it comes to this concept, there are two types of price action: imbalance and inefficient, balanced and efficient. Let's try to differentiate in between them visually and logically. In order to understand this one, we need a level which price is reaching for. So it can be formed without a level as well. So if we have three candles right here for the bearish example, and the wick of very first candle or the low should not meet the wick of very last candle right here. You see, they both are not meeting each other and there's clear gap in between them. That's what we call SIBI. While creating this price action right here, algorithm is only offering the sell side liquidity, which create the sell side imbalance and create the buy side inefficiency. Hence we call it sell side imbalance and buy side inefficiency. In short form, we call it SIBI. Same goes for the bullish candles. If we have three bullish candles and the high of the very first candle does not be the low of very last candle, you see we have clear gap in between them, we call it BISI. And the logic behind this one is that price is only offering the buy side liquidity, which create the buy side imbalance, and it is not offering the sell side liquidity, which create the sell side inefficiency. Hence we call it buy side imbalance and sell side inefficiency, or BISI. In the balance or efficient price action, we are offering both buy side with this wick and sell side with this wick. So there's no gap in between them. Hence, this is sell side balance and buy side efficient price action. Same goes for the bullish example. You see, we are offering buy side with this wick right here and sell side with this wick. Hence, this is balance price action as well. When algorithm create these types of price action, it will often come back to fill in between them because there's an efficiency of buy side or sell side liquidity. So it will come back, fill in the buy side for the bearish example, and then go toward the drawn liquidity. Or for the sell side liquidity, it will come back, fill in the sell side liquidity, and then go toward the drawn liquidity. Next, we have ICT fair value gaps. ICT fair value gaps are type of imbalance or inefficiencies which is formed after a certain stop rate when we have a clear drawn liquidity. So unlike the SIBI or BISI, the fair value gap requires the clear drawn liquidity and a confirmation in form of some stop hand or some liquidity sweep. Now, like any PDO, fair value gap can be bullish as well as bearish. Now let's understand the bullish fair value gap first. A bullish fair value gap has formed after a certain stop rate which took some sell side liquidity, and we have clear drawn liquidity to the buy side. So we go from sell side liquidity to the buy side liquidity. Once these two conditions are met, we have taken some sell side liquidity and we have clear buy side liquidity. Then we look for the price to create some BISI, buy side imbalance and sell side inefficiency. Now this BISI, if we mark it out with this 50% level and call it as our bullish fair value gap. Now then we wait for price to come back to it and fill in the sell side inefficiency and then go to other drawn liquidity. A fair value gap has three key levels: the starting, ending, and the 50% level. The 50% level is called consecutive investment. Now this level is the strongest in the fair value gap and we want price to close above it. It can wick below it, but we want price to close the candle above this price level, the 50%. As soon as price close above this fair value gap, we mark it as high probability and take our entry on the next candle right here to the drawn liquidity. Next, we have bearish fair value gap. In a bearish fair value gap, we go from buy side liquidity to sell side liquidity. You see here, if we have taken enough buy side liquidity and we are targeting the sell side liquidity, then we can look for the bearish example. Right here, you can see this gap. This is SIBI, in which we are offering enough sell side liquidity, creating an imbalance for the buy side liquidity. So price needs to come back and fill in for the buy side liquidity, going toward the draw on liquidity right here. Price comes back, hit this fair value gap, and then go toward this draw on liquidity. That's how the fair value gap works. In order to understand the ICT fair value gap, you have to understand this fact that not every SIBI or BISI is ICT fair value gap. ICT fair value gap requires a certain stop rate and a clear draw on liquidity at a key level. These do not form everywhere just like SIBI or BISI. There are certain types of fair value gaps as well according to their weakness and strongness. Like the weak fair value gap will always form near the drawn liquidity. You can see right here. That's the example of weak fair value gap. You see it's near the drawn liquidity. We do not expect price to come back and fill in this gap because it's weak. It's near the drawn liquidity. While this gap is very strong and it's pushing market very aggressively. So the strong fair value gap will form near the stop rate and weak fair value gap will form near the drawn liquidity. Next, let's understand the inversion fair value gap. An inversion fair value gap is the failed fair value gap if I define it in the simplest form. It is the fair value gap from the sell side delivered to the buy side or buy side delivered to the sell side. Like any PDA, it can be bullish as well as bearish. Now let's try to understand it in a bullish example. We can also write it as IFVG. Here's a chart example of inversion fair value gap, in this case bullish. You can see we are going from sell side liquidity to buy side liquidity right here. And if you pay close attention, you can spot this fair value gap, a beautiful SIBI, right before the sell side has been taken. And as we know that the strongest fair value gap or inversion fair value gap will always form near the stop rate. And this is nearest to the stop rate. You can see this is our stop rate and that's our inversion fair value gap. It is a failed fair value gap which has been disrespected by the algorithm, and now we can use it to get the support to other passive liquidity. We mark it out. We also try to mark its 50% level right here. This is the strongest level. We want price to close above it and then enter on the next candle right here toward the drawn liquidity, which is buy side in this case. So inversion fair value gap is a failed fair value gap from sell side to buy side. It has taken some sell side liquidity. It is nearest to the stop rate and we have clear drawn liquidity. So it's the valid inversion fair value gap. So this was for the bullish example in which we used a SIBI to deliver the buy side liquidity. For the bearish example, you can see here we have taken some buy side liquidity and we are going toward the sell side liquidity. And if you pay close attention, you will find this beautiful gap right here. See? The nearest to the stop rate is the strongest fair value gap or inversion fair value gap. This right here is BISI. It will be used as SIBI on the sell side. Right here. We mark it out as 50% level as well. The strongest level is 50%. If we want price to close below it, it can wick above it, but it has to close below it. And then we wait for price to give us entry on lower time frame or we enter just right here toward the drawn liquidity. That's how the inversion fair value gap works. It goes from one side of market to another side of market. Sometimes it's from sell side to buy side or from buy side right here to sell side. The SIBI does the work of BISI and BISI does the work of SIBI. That's the inversion fair value gap. We can use a failed fair value gap in our favor to get the support in the bullish case or the resistance in the bearish case. After the big explanation, now let's look at the examples. The chart in front of you is Euro USD 15-minute chart. You can use any other chart if you want. these gaps are present in any market. You can see right here, we are looking at a bearish move. We have taken this buy side liquidity right here, and this is forward bearish order block as well. Price is reacting nicely from this inversion fair value gap. Now this fair value gap has been disrespected by this aggressive move, and then it is being respected by this wick right here, breaking structure below and then going below. That's how the inversion fair value gap works. The strongest inversion fair value gap or just fair value gap will always form near the stop rate right here. You see, that's our stop rate. We have taken buy side liquidity and then we are going below, taking the sell side liquidity. You can see another examples right here as well. This fair value gap after price hit this higher time frame key level inside the forward order block, we get this beautiful fair value gap right here. Price gives us nice opportunity with this candle. By closing below it, we could have entered right here and then taken the nearby sell side liquidity. As I told you, the fair value gaps will always form the stop rate. You see, that's our stop rate right here. We have taken the buy side liquidity and we are going to other sell side liquidity. And we enter through this fair value gap right here with this candle. Every time price does some stop rate, we will enter on the next fair value gap that seems highest probable and price closes below it. There would be a lot of examples of it. You can see right here. Price is respecting this fair value gap as well. We have done this stop rate right here, buy side taken, and that's our sell side as our target. Equal highs. Look at the perfection. Price is not respecting this one right here, but it is respecting this inside the kill zone, the London kill zone with this wick. We would not enter with this wick, but we could enter right here or on lower time frame right here with this wick. Another entry with this fair value gap, bearish fair value gap, but it's the low probability. As I said, that near the drawn liquidity, the fair value gaps and inversion fair value gaps get weak. Price gives us a lot of entries right here as well on lower time frame. This would be a correct entry on 5 minute as well, and then it takes the sell side liquidity right here. So we went from the buy side liquidity right here to the sell side liquidity, and now we shift our structure to the bullish, breaking this high right here. But it's based on higher time frame that we know that we are shifting our structure. We could not say that we shift our structure just because we have broken this high. It can be a stop rate as well. But for now, as I know that this is based on higher time frame, we are shifting our structure, and then we look for the fair value gaps formed after this break of structure that could give us nice opportunities. One is right here. See, price give us nice entry, and then boom, it's right here. We could have entered right here, put our stop loss right here, and then targeted the US drawn liquidity or fair value gap. This one. As I told you, the higher probability fair value gaps will always form a stop rate. You see, we have taken the sell side liquidity and then we are targeting the buy side liquidity. Buy side resides above the highs. And this fair value gap. Once again, you see we have taken the sell side liquidity and then we look for the fair value gaps to ride the tide right here. And then we target the nearest buy side liquidity. It's as easy as that. Once you practice it, you will see it in real time. Now it might seem confusing that how am I marking these out, but once you practice it on your own chart, you will see them a lot. Sell side taken, buy side target, and then we get the entry on the nearest fair value gap to the stop rate. Right here, here. You see price goes extremely high with aggressiveness. Another stop rate. And then another entry inside the bullish fair value gap right here, and it repeats again and again and again. I can go all day marking this fair value gaps, but these won't end. Price always does it. You see, that's our entry and that's our stop loss. We would have put the stop loss below the fair value gap. We always put the stop loss below the fair value gap. It could have been right here or here for the safety. Once again, we have taken this low right here, and then we mark the nearest fair value gap. Yeah, sometimes it can be this big as well. Right here. That's our fair value gap. It comes right into it and then goes boom. Once again, you see, that's our bearish order block, 4-hour bearish order block. That's why price is being choppy at this moment. But we are also getting some entries as well. After this stop rate, the nearest fair value gap or nearest inversion fair value gap would give us the entry. Right here, you see how price is respecting these 50% level. It's exactly at the 50%. It's beautiful. Another entry right here, as I told you, near the draw on liquidity, our entries became low probability. It's right here, and we target the nearest low. That's here. Boom. And after the stop rate, we go high, tap the order block once again, and then price shifts its structure, breaking the significant low right here, and taking some buy sell liquidity as well. This is kind of unique setup. You get it once in a month. You see how perfect it is. Everything is just aligned perfectly. This fair value gap, order block, inversion fair value gap, the break of structure, another entry right here. We have everything we need. These are once a month moves. They do not repeat very well. Another entry and then price goes down to hell. That's it for this video. I hope you would backtest these concepts and try to understand them with practice. Stay sharp, stay safe.